One strike on Dimona, and the market would stop pricing a conflict. It would start pricing a nightmare. Because this would not be seen as another missile headline in the Middle East. It would be interpreted as an attack on one of the most symbolically dangerous sites in the region, a facility long associated with Israel's nuclear program. The Negev Desert, located in southern Israel, played a key role in the nation's strategic development and infrastructure. The moment that line is crossed, traders do not ask how much damage was done. They ask, how far does this escalate, and how fast? And that question alone is enough to hit markets hard. Israel's stock market is not a tiny stock exchange, has recently been measured in the hundreds of billions of dollars in equity market value, with official TASE material saying its equity market cap reached around NIS 2 trillion by of end of 2025. So if investors suddenly fear a direct Iran-Israel war spiraling into something wider, the first reaction is brutally simple: dump local risk. Israeli equities get sold, the shekel comes under pressure, government bonds get repriced, and insurance, aviation, tourism, and anything exposed to domestic disruption gets hammered first. But the real reason global markets would care is not Israel alone. It is what such a strike says about the next 72 hours. Once the world thinks retaliation is coming, everyone immediately starts looking at the Strait of Hormuz. Why? Because in 2024, about 20 million barrels per day moved through that choke point, equal to roughly 20% of global petroleum liquids consumption. The EIA also says flows through Hormuz accounted for more than 1/4 of global seaborne oil trade and about 1/5 of global LNG trade. In other words, if investors think this crisis can threaten Hormuz, oil does not need to disappear for markets to panic. The fear of disruption is enough to send prices violently higher. And once oil spikes, stocks start breaking in layers. Airlines get crushed, shipping costs jump, manufacturing margins shrink. Consumers pay more for fuel, transport, food, plastics, chemicals, and almost everything that moves through the real economy. This is exactly why energy shocks are so dangerous. They hit households and corporations at the same time. A Dimona strike would tell the market that this is no longer a contained geopolitical flare-up. It is a potential energy shock with military escalation built into it. That is when algorithms sell first and analysts explain later. Then comes the second punch: trade routes. Investors have already seen how fragile shipping becomes when the region destabilizes. The IMF reported that in early 2024, trade through the Suez Canal dropped 50% year over year, and ships rerouted around the Cape of Good Hope, adding 10 days or more on average to delivery times. That matters because the Middle East is not only about oil fields. It is also about bottlenecks, insurance premiums, freight costs, and delivery delays. So if a strike on Dimona triggers wider conflict, markets would immediately start pricing not one shock, but two: an energy shock and a logistics shock. Now add central banks to the mess. Normally, when markets panic, investors hope rate cuts will save them. But energy shocks are different. Higher oil and gas prices push inflation up at the exact moment growth starts slowing down. On March 19, 2026, Reuters reported that the EZBL raised its inflation projections because of higher energy costs, and warned that a prolonged Middle East war could leave inflation above baseline and growth below baseline. That is the nightmare setup for equities: weaker growth, stickier inflation, and central banks that cannot rush in to rescue markets without risking another inflation wave. A regional military strike becomes a global portfolio event. Fund managers start cutting exposure, not because every company is directly connected to Israel, but because the pricing model for risk changes everywhere at once. Emerging markets get sold because foreign capital hates uncertainty. European equities take a hit, because Europe is more exposed to imported energy shocks. Bond markets wobble because inflation expectations rise. Even companies with solid earnings get dragged down because when volatility explodes, correlation goes to 1 and everything starts moving together. That is what people mean when they say markets collapse on geopolitical fear. Not that every business suddenly becomes worthless, but that everyone tries to run through the same exit at the same time. And the psychological factor may be even more important than the physical one. A strike on Dimona would be interpreted as a strike on deterrence, credibility, and regional boundaries. It tells markets that previously unthinkable targets are now thinkable. Once that happens, traders begin pricing tail risk: miscalculation, retaliation, cyber attacks, shipping interruptions, infrastructure sabotage, and the possibility that other powers get dragged in. Markets do not need certainty to crash. They only need the range of possible outcomes to become too terrifying to value cleanly. The moment valuation models cannot confidently estimate the next quarter, cash becomes king and risk assets suffer. So the reason a Dimona strike could crush financial markets is not just because of the site itself. It is because of what the site represents: nuclear symbolism, regional escalation, oil choke points, shipping disruption, inflation shock, central bank paralysis. That is the full chain reaction. One missile hits a strategic symbol in the Negev, and within hours, traders in Tel Aviv, London, Frankfurt, New York, and Asia are all asking the same question. Are we still pricing a war? Or are we pricing the start of something much bigger? That is why the sell-off would be so violent, because the market would not see Dimona as a local event. It would see it as the moment the Middle East stopped being a headline risk and became a global economic risk. And when that switch flips, money does what money always does: it runs. And that is why one strike on Dimona would not just shake a region. It could trigger the kind of fear that makes global markets unravel in real time.